So good evening, everybody. Finally, it's IFRS. Everybody used to request us IFRS sessions, and we should really thank Balaram for organizing this and our chairman, obviously, for leading us from the front. But it's a marathon of IFRS now, 3 days consecutive session. I think in the last 3 years is the first time we have done this, and it's an excellent initiative. So thank you very much for joining. And it is a time where IFRS become very crucial because of the CT. So thank you very much. Let us learn to the maximum, and I will not keep you all engaged. You all know the speakers very well already, and a lot of learning going on and a lot of events happening in the next few months, online especially. So let us take advantage of it. I would also request Jaibai to add a little here before the session starts.
Thank you,
You
Ashna.
want
Thanks
to
a lot.
say something?
No, I'll quickly say online sessions we will be having more. Why I say because there are members who have kids at the home. There are members who have elderly people at home. There are members who are not able to travel. So you will be seeing more and more online sessions for learning going on because learning nowadays in UAE is very critical in terms of IFRS, in terms of taxes, in terms of AML compliances. So you will see more of learning. Let's get used to it because that's the easy way to learn faster instead of traveling. I'm not saying that you will not have physical sessions. We will be doing physical sessions, but yes, now it will be a mix of physical and online sessions. It's a toll on us. Please trust me when I say that. For the XCOM, it's a toll because we are arranging for the physical event on 31st. Now, for last 3 days, we are joining this, but this all for you. I mean, because we want my members to learn more and more and be educated on that. That's the reason we are doing it. With those thoughts, let me go ahead straight away directly to the speaker. Satya, you will start off with the summary portion. But before you go, I have to thank one person who arranged for it. Two people, actually. Rashita, being the champion, she is coordinating with Balram, our XCOM member. These two people are the reasons. Please do show their love and claps for them because they are the people who arranged for it. And Balram, you want to say something on for the session? Today is the last day for IFRS 9.
Thank you, Jaibai. Good evening, all, and thank you, Ashna. No, I just wanted to thank both the speakers. They have put in a lot of efforts. As everyone is aware, IFRS 9 and other related standards are really technically they are like highest in IFRS standards if you see all together. So taking these sessions 3 days to continuously dealing with those standards definitely is a challenging task. And I thank both of them to put this forward together and then coming forward to part their knowledge and wisdom. And I thank each one of you who've been attending for last 2 days and looking forward for more and more online events on IFRS and other topics also. I just wanted to thank the committee also, including along with Jaibai for accommodating this. And yes, thank you for that.
Thank you. And we'll directly jump to the sessions now. Ravi, please go ahead. Or Satya, you have to go ahead because you will summarize first.
Yeah, no, Mr. Ravi will be taking and he'll hand over to me.
Vice versa.
Yeah, good evening, everyone. Thank you, ICA Dubai. Thank you. Thanks for the opportunity once again. Right. Let's, before getting into, is it voice clear?
Yes, perfectly clear.
Yeah. Before getting into the today's session, let's have a quick recap of whatever we discussed, maybe 5 to 10 minutes maximum. Whatever we discussed on first day and second day. Yeah, first day we had a discussion of what is a financial asset, what is a financial liability, and what is equity, what is a derivative. Definitions are covered, right? And the second, at the same time, the initial recognition, subsequent measurement, right? What is initial recognition? Financial asset, financial liability, everything initially is going to be recognized at fair value, right? With respect to transaction cost, if it is treated as FETPL, transaction cost will be transferred to profit and loss statement. If it is other than FETPL, that is FETOCA or FET amortized cost, then transaction cost is going to be added to the asset or deducted from the liability, right? Subsequent measurement that is as on the balance sheet date. It depends upon the two tests. One is business model and the next one is SPPI test. Yeah, what is your business model? Would you like, I can say there are three types of business model. Model number one, I wanted to hold it till the end and I wanted to get the contractual cash flows. Okay. And the second business model is Yeah, I wanted to hold it, but in between, once my objective, say there is a debt instrument, the period is maybe 5 years, but I know my objective is after 3 years, I get some requirement. So I would like to sell it after 3 years. So then it will come under second category. And the third category is I don't have any objective. Whenever I get a profit, whatever, there's no clear objective is there. Whenever I feel I'll be able to sell it off. So in this, the third one, I can say residuary business model, right? The second test is SPPI, solely payment of principal and interest. So it is based on the characteristics of the cash flows. The question is it a plain debenture? Okay, plain debenture. If it is a plain debenture only, then contractual cash flows will be there, and whatever you get is a principal plus interest. And again, debenture should not have any other elements like conversion option. No, there should not be any conversion option. Then does it satisfy? Yeah. So if it satisfies, say you are in the business model number 1, where you wanted to hold it till the end and wanted to get the contractual cash flows, plus it satisfies SPPI test. That means it is a plain debenture kind. Then only I can go with amortized cost classification. And the second one, I have an objective. I know clear objective. I need the money after a certain period of time. Plus I satisfy SPPI test. Then I'll go with FET OCI classification. Right. Rest all is going to be classified as FETPL. With respect to equity instruments or investment in equity capital or equity instruments,
Ravi bhai,
obviously don't have any
your slides
contractual
are not
cash flow.
moving.
No, not moving. This is just a recap.
Recap. Huh.
Perfect.
Yeah. So that is the point basically. Right. So rest all is going to be considered as FETPL. Right. So at the same time, next, right, only in case of equity instruments, at the initial recognition itself, you have an irrevocable option. I can classify it as FET OCI rather than FETPL. Naturally, an equity instrument is always going to be FETPL. But yes, by a irrevocable choice, I can treat it as FET OCI. Right. So that is day 1 information. Day 2 information, what is that we had looked at? The classification done in day 1. So reclassification we have discussed. Correct. Reclassification when there is a change in the business model. When there is a change in the business model, then obviously, you can do the reclassification. Again, as we discussed, reclassification is applicable only when it is a plain debenture situation. Right. Other situations, no, it is not possible. Right. And again, it is only prospective accounting, no retrospective accounting. Right. And the difference between the carrying amount and the fair value on the date of reclassification will be transferred based on the new classification. If I am going to FETPL, the difference will be transferred to profit and loss statement. If I am moving to FET OCI, the difference will be transferred to OCI. Okay, right. At the same time, if you are moving from FET OCI to amortized cost, then whatever the fair value on the date of reclassification will be considered as a new carrying amount, and you are supposed to calculate a separate AIR. Right. And the next topic, what we discussed yesterday, is derecognition of financial liability. Right. We derecognize the financial liability when there is an extinguishment of liability. We are no more responsible. I don't have any obligation to settle it. I'm done with it. Or it may be waived off by the legally it is waived off. That means I don't have any responsibilities. Yet then you can take out your financial liability from the books of account. Here we have considered, right, what is the, if there is a restructure of a loan, what is the impact? Is it a 10%? If it is greater than 10% impact, that is substantive modification, then you are supposed to derecognize the old loan, old financial liability, and recognize the new financial liability. And if there is any difference, that will be transferred to statement of profit and loss. If the modification impact is less than 10%, then we will adjust the existing loan only, will not, derecognize and recognize a new one. Right. Derecognition of financial asset also we had discussed. Derecognition of financial asset, when I say I don't have any, significant risks and rewards, and significant risks and rewards are not there, and I don't have any control over the financial asset, then please derecognize it. But sometime what happens, it seems like we transferred it, but actually I have a continuing involvement in that financial asset which is transferred. Under that circumstance, you should not derecognize the financial asset. Okay, continue to hold it, but whatever the money you have received, that should be recognized as a financial liability, right? And the last topic we have discussed, ECL, that is impairment of the impairment. Okay, then impairment or expected credit losses with respect to financial assets, right? We have discussed like whatever it is classified as FVTPL, any financial instrument classified as FVTPL is scoped out of it. A debt instrument which is classified as a FVTOCI, amortized cost, is going to be right routed through this. And in simple words, I can say ECL is nothing but present value of cash shortfall, right? How do you calculate present value of cash shortfall? EAD, that is exposure at default, into probability of default, into loss given default. Okay, right. So probability of default, as we discussed, there are a number of models are there. Right. Today also, after my first, I would like to take up FGC. Right. After that financial guarantee contract, we'll try to spend some time. Afterwards, I'll take you through some PD calculations. Right. Probability of default, like in probability of default, again, further it is going to be divided into TTC PD, through the cycle probability of default, PIT TT PD, that is point in time probability of default, right? What are those things? I'll try to show a little calculations to just get an idea, right? Obviously, nobody can make, 100% covering, 100% going in depth is impossible in the session, right? But I will try to give a glimpse of it. Okay. So like that we have, last few examples we have taken, like with respect to CRISIL, whatever they have given based on the last 10 years of their experience, what was the probability of default, we have utilized their calculations, right? That is all we have seen in the last session, right? Today's agenda, let's get into today's topic, right? Today's agenda, right? Yeah, we'll handle there are some questions. Surely we'll handle this question towards the end. We are giving approximately 10 to 15 or more than 10 to 15 minutes for the questions. Very happy to answer whatever is possible. Okay, right. Yes. So chalo, let's go to the today's topic. Today's topic is financial guarantee contract. Yeah, yesterday we just touched upon very little, but this is what generally normal, where the parent company will give a guarantee for the loan taken by the subsidiary, right? How do we present it? Right? How do you present it? It's not going to be presented as a contingent liability in the financial statement. There is some accounting as per IFRS 9, very clearly, it is explained, right? Let's look at it that point. And linking the IFRS 9 with corporate tax, Satyavart is going to handle this. And presentation disclosure of IFRS 7, basically, that again, I'm going to close that. And the fourth one is again question and answer session. Yes, let's try to answer your questions from IFRS 9 to the extent possible. Okay, chalo, let's get into the main topic of the day. Yeah, financial guarantee contract. If it is a local GAAP, say IGAP, Indian GAAP, as per accounting standard 29, I say, if a parent, subsidiary has taken a loan, right? That loan is, for that loan, a parent has given a guarantee to the banker. Yeah, what we used to do, what we are doing right now also, as per if it is IGAP is applicable, we just give a contingent liability disclosure, right? But as per IFRS 9, it is something different. We need to account for even that at fair value. So how do you calculate the fair value? What will you do exactly? I have some example in Excel. I'll try to show you that calculations, right? First theory, I'll try to explain it to you. And then I'll take you through the Excel calculations that will give you a good idea. Okay. Reasonably good idea. That is very much possible. Right. So what is the definition which is given in the IFRS 9? So it's a contract that requires the issuer to make a specified payment to reimburse the holder for a loss that incurs. Yes, banker has given a loan to my subsidiary, right? In case my subsidiary defaults that. So banker is going to lose something. Whatever the losses going to be incurred by the banker has to be borne by the parent company. Correct. So it's, yes, it is a financial guarantee contract. Right. So what are we, what is the best simple example is, this is the simple example. 1 second. Yeah. So parent guarantees the loan of a subsidiary. Right. As I said, IGAP, it is just a contingent liability. Disclosure. No journal entry, no impact, no presentation other than, I mean, disclosure is only contingent liability. Right. How are we supposed to recognize as per IFRS 9? Right. Initially, like I said, when I say it is going to be a financial liability, yes, it is a financial liability, not for the entire amount of the loan. Right. So that's why that always the question will come. You say you should recognize it at fair value. Yes. Then how do you calculate fair value? Right. Just imagine one small circumstance. Right. We get a bank guarantee from the banker. Whether the banker charges for the same? Yes, answer please. Whether the banker charges for the same or not? Yes, obviously. Correct. No? What rate they charge? Somewhere some 0.75 to 1.25 banker to banker, it will change. Correct. No? So here in this situation, parent company has given a guarantee to the banker. Right. Banker has not given, but parent company has given a guarantee. Right. So isn't it like my opportunity cost? Isn't it like I gifted this amount to my subsidiary? If subsidiary has gone to a banker would have charged some money. Say example, $1 lakh. Simple, whatever the number, 1 lakh I say. That 1 lakh, isn't it a gift by the parent to the subsidiary indirectly? Yes. Isn't it like a capital contribution? Exactly, yes. So that is going to be accounted for. Right. I gave a guarantee. Is that I am full free? Obviously, you're not free. Correct. Now, what is that you have risk? Yes, there is some risk. That is nothing but the fair value of the guarantee is at my risk right now. Okay, but we'll measure subsequently a different way, which I'm going to explain it to you. Right. Yeah, risk of the parent. Correct. Exactly. See, again, often, I mean, how do you calculate the fair value? So generally, what do you do? Present value of the expected cash flows. Yes, if it is issued, correct. If it is issued at arm's length price, correct. Same time, listen, one more thing. If loan goes to if the subsidiary goes for a loan to the banker, say example, they are offering at a 17% without anybody's guarantee. Okay. My subsidiary is a newborn company, or maybe making losses and maybe not such a sufficient amount of profits, or they don't have that much amount of collateral to provide. So the minute I say my parent is there, they are going to give you a financial guarantee. Then automatically what happens? If earlier they wish to charge 16%, now because of the parent guarantee, they may charge only 15%. Yeah, because banker has less risk. So lesser risk, obviously, correct. Now, so we'll get at a 15% rate only. So what do we do generally? So there is a benefit of 1%. So there is a benefit of 1% cash flows throughout the period of the loan. We'll identify 1%, correct. Now, if I calculate at 16%, what will be my cash outflow? Now I am getting actually 15%. 15%, what will be my cash outflows throughout the loan period? The difference is nothing but the benefit. That benefit of the, say example, loan is for 3 years or 4 years. I'll bring that into a present value. Again, sir, which rate you will apply for present value? Which rate is that a fair rate? Fair rate is, if I go there without my guarantee from the parent company, I would have got at 16%. So at the rate of 16%, I am going to discount all these cash flows. That's nothing but my fair value. That is that price I am going to recognize a financial liability. I'll show the numbers. Just you need to have little patience. Okay. Yeah. At the same time, not only this, another way also is there, as I said, just behave like a banker. Banker would have charged 1%. Example, right? This is another way. Okay. Some firms will follow, some firms will not follow. That depends upon person to person. Okay. So I have taken a loan of say 1 CR. 1 CR into 1%. So directly 1 lakh will come. 1 lakh is my fair value. This would have been charged by the banker. That is what forgone by the parent company. So I'll say 1 lakh is my fair value. That way also you can calculate, right? So if it is issued for free, yes, obviously generally parent to subsidiary charges will not be there. Yes, that is where fair value calculations will come. In this entire standard of IFRS 9, wherever I say fair value, then obviously we are supposed to look at IFRS 13, the fair value principles. Okay, initially some value we determine. Okay, super. Otherwise, are you able to see my screen a change right now? Are you able to see this?
Yes.
Yeah.
Excel? Okay, fine. Yeah. Chalo, let me take you through some small example of some company, some fact. Okay. See, in this case, the contract price, what they have got the loan is at 16.5%. Okay. Right. So what is that simple calculations we have done here? Okay. See, the loan has been taken on so and so date in 2020-23. Correct. The loan is there till 8/4/2020-25. It's almost 2 years of time, 760 days loan period. Okay. So the amount of loan is nothing but 5 crores. Okay. I have calculated what is the cash flow. That is nothing but the EMI portion. Okay. Interest and principal has been bifurcated. This will come directly from the loan statement. Loan statement, that is a simple number. Correct. So fair interest rate, if it has been the fair interest, so what is my rate? My rate is 17.5% is 7. This is the actual rate right now, the charged by the banker. If I had gone without a guarantee, my parents' guarantee, they would have charged 17.5%. So 1% is a benefit. The 1% exactly from where you got it. It is a general standard. That's what everybody follows. Yeah, you can take 0.75 also. If you can take 1.25 also, it is a professional judgment again. One is fair enough. That is what I feel. Okay, right. So fair interest is I'm applying 17.5% on my outstanding principal. Right. That's how we have determined all the fair interest calculations. Okay, excellent. So now what is that? The interest difference. The interest difference, what is the current charge? That is the G column number. And what is the fair interest? Correct. So isn't it, this is the benefit that is derived by the subsidiary, correct? Or this is what the benefit a parent gave it to a subsidiary because of the guarantee. Okay, that's also, this is the amount I'm not totaling. What do I do here? Simple, my fair value calculation. Okay, I apply X NPV formula. So the dates and the amounts, I just apply NPV, right? At the rate of what rate are you calculating? Fair rate always. Correct. Now, fair market value you want to find out, then you have to apply the fair rate. That is nothing but 17.5% is the fair rate which we have determined. So at the rate of 17.5%, if I do the calculation, yes, it comes to 6,61,712. Okay. So now what is your journal entry? Correct. Now that is obviously, that is the basic question will come. Right. First, where are we? That is more important. Suppose if I say I am in the parent books. Okay, yes, I am in the parent books. Isn't it an advantage? Is it like some contribution to the subsidiary company? Yes, it is a contribution. Yes, that's why it is nothing but investment in subsidiary account debit. In the parent books, I just simply say that is nothing but 661 is the number, and to what? That is my financial liability, FGC, financial guarantee contract, whatever that name is, nomenclature is never an issue. It is supposed to be classified as a financial guarantee, right? This is the number, I'll keep it. This is in the parent books. Okay. Now, this is where is it said? It is very clearly explained under IFRS 9. For this, we don't have any doubt. Okay. But is it said by the debit is told by IFRS 9 or credit told by IFRS 9 or both are told by IFRS 9? Only credit they will tell. Okay, they told. Debit they have not told. But yes, that is the principle. So basic principles of accounting. So I can go ahead with this. Okay. And can you just imagine what will be the journal entry a subsidiary will follow? Can I expect some answer? What should be the journal entry in the books of subsidiary? Yeah, subsidiary has taken a loan already, that we told, correct? Na? Yeah, so loan journal entry is very simple, right? Loan journal, bank debit to loan, that is what we record. Yeah, that is equal to my 5 CR, correct? Na? Right. What could be the journal entry? Just guess, whatever it is. Let it go 100% wrong. How does it matter? Try what this is normal loan, right? Because of the guarantee, do I need to account for? Do I need to account for? Few more seconds, I'll wait. Retained earnings will be credited. Super. Yeah. Shamu, for subsidiary bank account debit. No, I'm not receiving any money. Correct. So a fair value, fine. For 661K, guarantee finance expense debit. Okay. Capital contribution credit. Very nice. Yeah, finance expense, loan cost, transaction cost, interest expenditure, any name, it will work. Right. Awesome. Awesome for the try. That is very, very happy. Right. See, the first and foremost point here, IFRS 9 is silent. First thing I would like to say, IFRS 9 is silent on this. IFRS 9 spoke only on whoever is giving the guarantee, right? So from the receiver point of view, it is silent. But we can do one small thing here, right? There are two opportunities, right? This is always like when the standard is silent, then it is opening doors for the accounting policy choice. Obviously, because standard is silent means yes, I can apply my own accounting policy, right? So first accounting policy, a best accounting policy, simple accounting policy, I would like to say, I will say my loan 5 crore is already at fair value. Okay, whatever the loan I have got it, that is already at fair value. Okay, that means what? Whatever the benefit I got, that 6 lakh rupees, I don't want to account it. So I mean to say, no, don't account only. That is, don't account, but assuming, yes, it is assuming the debt is already at fair value. Already at fair value. So, okay, but in consolidation, what will happen? Consolidation means what will happen? Who accounted for? Parent accounted for. Parent only will reverse it. That's all. Nothing to knock off. Right? Job is done. Right, other way around. Okay, this is obviously more reasonable. I agree with you. Right? The second way is is it an integral part of the loan? Is it an integral part of the loan? Exactly, yes. Correct, no? Yes, all of you. I think you agree with me. Is it integral part of loan? Correct. Now this benefit, whatever has come, right? If example, instead of the parent company, if I had gone to a banker, I would have paid some money as a commission. Yes or not least? I would have paid a commission. No? Yeah, here I'm not paying, that's all. But it is correct. Now I would have paid this amount of commission. Right here, actually, I'm not paying. So yes, I agree. It is an expenditure end of the day. Right. This is which kind of expenditure? It is directly linked to my loan. That's why it's integral part of loan, I would like to say. That's why what do I say? Yes, loan expense or transaction cost or interest expenditure, finance cost, whichever the name you want to call it. Right. This I will treat it as a transaction cost account debit to your retained earnings. Yes, retained earnings. It is like a capital, I mean to say capital contribution. Yes, it is like a capital contribution. I should treat it. Means what will happen? What will happen? Nothing will happen. Very simple. Correct. Now, I will say, since it is a loan transaction cost, okay, I will take my loan amount minus this. This I will treat it as I'm indirectly debiting the loan. When I debit the loan, my loan balance would have been 4.93 CR. Okay, so now what am I going to pay? I already given a list what all the cash flows are going to be done. Now, this is a cash inflow to me. This is a cash inflow. Yes, cash inflow to me. And outflows are already determined. This side I have determined. Now I'll calculate EIR. So indirectly, this is going to give an impact on the EIR calculation under amortized cost. It's going to impact my EIR calculation, right? Okay, right. So this is one, this is just, where are we right now? We are at initial recognition. Day one, what is supposed to be done? Day one, parent is going to record this. Subsidiary has a choice because the standard does not. Okay, right. Correct. The standard is silent. That's why this choice of accounting policy is always there. Right. So chalo, let's go to the slide and we'll come back. Fine. Yeah. Uh, Okay, right. Examples. Let me clear this little concept and I'll come back to the questions. Okay, right. What is a subsequent measurement? Yeah, subsequent measurement is on 31st March and the balance sheet date, 31st December, whichever it is. Correct. How do I measure it? Is that my number of 6,21,000 will continue throughout the life? No, no, it's not going to be. What are we supposed to do? Right. There are two numbers. Out of this, whichever is lower will continue in the balance sheet. Okay, right. The second point is a simple point. First, I'll clear that, then I'll go to the first point. The second point is the amount initially recognized. Yeah, that is 6,21,000 rupees minus amortization. Right. What do I do? This 6,21,000 will be amortized over the period of loan. Okay. So what can we do? There are again here also, as I told you, here it's not very clear by the standard. That one method people do follow a simple method, right? We'll transfer it on based on the time period. We'll transfer it to profit and loss statement. So FL, it is already a liability. When I de-recognize, in the sense when I amortize it, it will become an income to the parent company. It will become an income to the parent company. That is FCL account debit to your profit and loss statement. Other income you can take it. That is this number is amount initially recognized minus amortization during the current year. Yes, that balance is one number, right? Next number is loss allowance. What is this loss allowance? Why the ECL is under impairment model will come? Yes, now on 31st March, we need to measure what is the probability of default by my subsidiary. Correct. What is the probability of default by my subsidiary? I gave a guarantee, correct. Suppose the financial position of my subsidiary is bad. Correct. So that the probability of default by the subsidiary may be very high number. So under that circumstance, right? So suppose example, subsidiary is doing not good at all. Correct. When there is a high level of default is there, then 5 crore will be my responsibility. Correct. Right. So now the question will come. So what is the probability of default by the subsidiary is first question. That is PD. Okay. In case of default, right? How much I can recover? Yes, some percentage will be recovery will be there out of the assets of the subsidiary. Correct. Right. Now, what is my provision I should make? Considering the provision, correct, considering this number. Okay, right. Say example, that comes to say 1 CR. My number of what is the book value right now? 6 lakh minus X number, because amortization I have done it. Say example, by divided by 2, I did 3 lakh and odd is sitting in my balance sheet. Suppose if the probability of default is very high because of the financial position of my subsidiary, if it comes to say 1 crore, then what number should be there in my balance sheet? What number should be there in my balance sheet? Obviously, I think whichever is low. Yeah, it should be 1 crore should be there. My symbol is wrong maybe. Okay, right? It's not 0. It is supposed to be the highest number. Whichever is higher is supposed to keep it here. Okay, right. Just a second. I'll take this. How do you calculate the ECL impairment and calculations also? I'll take you through. Okay, before that, I would like to answer one question asked by Vishwanath sir. Okay, the example you have provided has an element of opportunity cost. Yes. How does this work in a scenario where the subsidiary is a newly formed and not in a position to get any bank facility, but parent arranges this SBLC based on which the local bank arranges a facility. For the sake of clarity, all the changes for arranging this is anyways recharged by the parent to the subsidiary, and the borrowing cost on the facility is also borne by the subsidiary. Yeah, see, 100% I agree with you. It is opportunity cost, right? Considering sometimes if the banker doesn't give any loan also, I mean, practicality it will keep on changing, right? If the banker does not give means, then I, as a parent company, I only have to take a loan and I have to support them, right? The situation is different if my subsidiary, but considering my existing position, if they go for a loan, what rate they would have got, that opportunity rate, if they have gone on their own, and if I have given a bank guarantee, what rate benefit will be arrived, accordingly we are just doing it. Okay, right. Chalo. Let's go with a small calculation here, right? 1 second. Yeah. Again, yes. Whenever I say ECL model, right? So now basic question will come whether ECL again 12 months ECL or the lifetime ECL. Here there is a very clear clarity on this. It's always you are supposed to go with the lifetime ECL with respect to the FGC contracts. Okay, so estimate the credit risk of guaranteed party. That means the probability of default of not mine, probability of default of the subsidiary I am supposed to consider, not the person who gave the guarantee, obviously. So what are the complexities? The reliance on the borrower's credit profile. Yes, one needs to consider. Yes, interaction with the guaranteed party default probabilities. Yes, macroeconomic overlays very much required. Correct. Now, what is the position? What is the impact of the economy? What is the geographical geopolitics situations? Correct. So many things we are supposed to keep it in mind for this ECL calculation. Okay, right. So how to write? One small scenario is there. Here, there is nothing, no amount calculations exactly. This is already explained to you, but let us just take it through. Right. Parent company, okay, provides a corporate guarantee to a bank for 100 crore loan taken by its wholly owned subsidiary. Okay. No guarantee fees is charged. Normal, natural. The loan is repayable over a period of 5 years. Right. So this is the same example. Like in my example, we have taken only for 2 years. Right. So even though there is no consideration is received by me, still parent company has to recognize the FGC liability. Okay, right. And that is the whatever different approaches are there in calculation of fair value, whatever suitable to the company in the given circumstance, that is supposed to be done. So what could be the entry in the books of the parent company, as we discussed, investment in the subsidiary company to a financial guarantee liability or financial liability, that will be my basic journal entry in the books of the parent. Okay, on the balance sheet date, it's a lower of whatever the amount initially amortized, initially recognized minus amortization, lifetime ECL. Correct. Lifetime ECL amount is supposed to be brought in. Okay, right. ECL implication, as we said, this is a repetition. Let me take you through the ECL calculation little bit. Right. I'm just going to my Excel. Okay, this is the fair value calculation we have already done. So ECL on FG. Right. Are you able to see the screen Excel?
Yes, Ravi.
Yeah, thank you. So with respect to this loan, right, my ECL has come to, say, example, 2 lakh. How did it come? Right. So my exposure, what is the exposure at default? My exposure at default is equal to as on 31st March 2023, because that date, if I have taken 5 crore is the amount, plus that few number of days of interest, if it comes together, the exposure is 5 crore rupees. Right. So the ECL purpose, what is that we have applied? We have considered the PD into LGD. Okay. So loss at given default, we have taken, there are some thumb rules we have seriously followed, not exactly measurement. Okay, because considering the net assets, what is held by so and so subsidiary company, we have taken this percentage. And this 0.48 or 0.65, 0.53, different probability of defaults, again, based on the CRISIL information. Yes, they do every year, they will provide a report. Okay, right. Based on the credit rating in this situation, in the present situation, my subsidiaries credit rating was BB. Okay. So what is applicable? What is the probability of so and so BB rated company becoming a default? It was only 0.48 percentage. And that's why we have applied only 0.48 for the 24 financials. 23, it is 0.53. Right. It's all based on the CRISIL information. I have just taken it. Right. We just multiplied all these numbers. Right. Exposure default, probability default, and LGD I have applied. So my number is equal to 2 lakh that has come. Okay. Right. So, yes. Yeah. It is not 1 year of PD here. It should be taking lifetime. Right. That's what I said. There is no 1 year, 12 months. It is always 1 year PD is supposed to be considered. Okay. Right. So at the same time, right. Next point, if you say, what is the fees income? Right. I think this is already calculated. Done. Yeah. That amortization amount, what I'm trying to explain, your total fair value, what you have recognized is 6,61,000 rupees. That is going to be amortized over the period of 3, because the dates are falling in 3 financial years. So that's why based on the number of days, it is going to be amortized over the period. So at the end of the day, it is going to be 6,43,000 is going to be my financial liability after amortization. Okay, right. Shall we go to the next small bit? Right. Now, this was, see, in my situation, yes, the company is very good NBFC company. It has a lot of, the loan book is very good. And even after providing a, like almost 60% of 60% of NPA as an ECL, still their financial position was very good. So that's why for my company, the 0.53 or 0.48 will be perfectly all right. Okay, it depends upon situation to situation. I told you are supposed to consider the credit, I mean, the book value, the balance sheet financial position of the subsidiary company you are supposed to take into account. Okay, it's very difficult to judge and take one example, but in the given company, it was perfectly all right. Yeah. See, this is one more small example, right? Do I need to consider this kind of thing also is one general question. Yeah. Can you please run through once? Right. What is the situation here? Say Mr. A is an individual promoter of a startup company X. So they gave a personal guarantee. Yes. It generally happens in every company, startups especially. Correct. So in this case, startup company, okay, company has taken 10, company has taken 10 crores of working capital loan. Mr. A has given a guarantee. It's a personal guarantee, right? So there is no formal agreement between the company and this, and Mr. A has not charged any fees. So now what should I do? Should I book the guarantee expenditure? Okay, there are two answers. No. Why no? Why yes? No is okay, yes is okay. Both are okay. Okay, because the receiver is nothing mandated. Okay, right. Assume we wanted to account for. I told you, since it is not mandatory, I agree with you. Right? Again, when it is not mandatory, it's a policy choice. Correct. So then what do I do? Should I book it? Startup is a company. Startup is a company. Person is Mr. X. Yes, exactly. This, I'm not taking the working capital loan at fair value. That is the first option, as I told you. The second option, I am going to take it. Yes, I'm going to take the second option here. Does it qualify for financial guarantee contract? Yes, even though there is no formal agreement, this has to be considered. Why should it be considered? Because of the other party, correct? Na? Right. If what do I say? If Mr. X is acting in his capacity as a promoter, yes, and the guarantee is going to increase the credit worthiness of the company. So that's why we must recognize this. And this is like on capital contribution, deemed capital contribution without any doubt. Yes, it is supposed to be recognized by the company. Correct. Obviously, the other party is Mr. X. X may maintain the books, may not maintain the books. Obviously, IFRS may not be applicable to him. So I don't need to bother about the Mr. X point of view. But yes, I would like to account for as my company's accounting policy choice, purely a choice. Okay, that's what loan processing cost or loan account debit to equity capital contribution. I would like to take it up this one. Fine. Right. Next, one more small scenario. Let's try this one. Okay. Company A, B, C are part of common group. Okay. Group company means all of you, obviously, we know parent and its subsidiaries are called group. Right. Obviously, associate and joint ventures will never be called as part of the group as per the standards. In general language, we do say, yeah, group includes associates and joint venture, but technically, no. Done. So each guarantee the other's external borrowings. Fine. So company B has 20 crore rupees of loan guaranteed by A and C. Both the companies put together have given a guarantee to to the lender of company B. right? No consideration is charged by both because all of them are group companies, right? So what should I do? So how should A and C should account for this? Because the providers, A and C, should it be accounted for? What do they account? How do they account? How does the lowest test apply when the guarantees are correct? Like it's not given by one party, it is given by two party, right? Is it double counting is going to be possible? What's your answer? Try. Any answer? Fine. Let me take it up. Right. So initial recognition, yes. A and C must recognize. Yes. Proportion of the financial guarantee at fair value. Correct. If both of them must have already entered into an agreement saying that, okay, to the extent of 40% I'll give guarantee, to the extent of 60% other party will give the guarantee. So some ratio must have been fixed. When I'm giving a guarantee, yes, obviously I'll mention that out of 40 crore, this is mine, this is the other party's loan. So yes, this is going to be considered as investment in the other company. Yes, this is standalone, it will be there. And as you know, in consolidation, it will be knocked off. Right. And financial liability will be considered. Right. So what about the subsequent measurement? How should it be considered? So estimate the lifetime ACL. That is, I mean, there is no question on that. Considering the joint and several liability, correct. First, individual, as I told you, when you are measuring the ECL, we have to consider the probability default of the company B. Okay. Then whatever the answer comes, that should be bifurcated between these two parties based on their contractual things. Right. It is not going to lead to a double accounting. Everybody, I mean, both the people are going to record their portion of this one. Okay, right. One more thing. Yesterday, I think if I remember correctly, Mr. Shamu was saying, what is that? A comfort letter. Right. Am I correct? Comfort letter. Right. I think by mistake or maybe in the flow, I must have told something. Right. If it is a comfort letter, this forget about this situation number 4. Okay. If parent company gives a comfort letter to the banker, what is your situation? Will I consider it as a financial guarantee and shall I do this application or not? It is a comfort letter. Okay. Mixed answers. No, no, yes. Why yes, why no? If you tell, that will be more easy for me. Okay. It's a letter of comfort. Yes, yes. No legal standing. Wow. Right. Awesome. That's it. It's not a guarantee actually. What Yash or other part, I mean Manish have told, in case of a comfort letter, I'll not consider it as a guarantee contract. Yes, because there are so many legal cases in the entire country. I mean, in India is there, outside India is there. Just because it's a comfort letter I am providing, I don't have any legal binding. If something, if he defaults, if the other company defaults, it doesn't lead. It's not going to bind me. So I don't record anything. Okay, right. You can disclose it as a contingent liability, maybe as a fair practice, but otherwise, this concept of FGC, financial guarantee contract, does not come into the picture. Okay, that's the simple clarity, right? So financial institution issues a third party guarantee. This is very easy. All of you will answer. I'm very sure about it. Okay, NBFC issues a credit enhancement guarantee to a bank for a third party borrower. Okay. NBFC is giving it to third party where third party has taken a loan from a banker. Okay. And if for a fees of 5 lakh rupees, my NBFC has charged 5 lakh rupees of fees. Okay. That's normal business. Correct. Now, XYZ Limited, whoever the person, has a high risk counterparty. Okay. And the NBFC exposure, that means the party has taken 15 crores of loan from a banker and my NBFC has charged only 5 lakh rupees as a fees. Right. What do I do in the books of NBFC? Who has provided the guarantee? Yes, please. What should be recorded in the books of NBFC? Initial stock. Why it is contingent liability? You have received the money also, isn't it? 5 lakh rupees fees has come. So first bank account is supposed to be debited. Correct? I cannot record bank account debit to contingent liability. Yes, it is IFRS 9. Again, it is a financial guarantee contract wherein I gave it to a third party. How does it matter? I have to recognize money. Correct, na? Right. It is a very simple thing. You got the money, so bank account is going to be debited. It's a financial guarantee contract. So again, 5 lakh rupees, is it a fair value? Yeah, it's an arm's length transaction. It's a third party borrower, I told. Correct. Now, banker ko I'm giving. So I don't have any related party like a parent and subsidiary. I am assuming 5 lakh rupees is an arm's length price. That is the fair value actually in that market assumption. Because in the absence of the information I have provided, let's take that itself is the fair value. So yes, bank account debit to
Aija?
financial guarantee value only you can take it.
Only Myanmar pending. അന്നാള് പറയാൻ.
Right? Yeah. So that is the fair value. That is the 5 lakh
Oh.
rupees.
Yeah, we'll look at that. Yeah.
ഓ അതെല്ലാം ട്രാൻസ്ഫർ ചെയ്യണല്ലേ?
Some voice.
ഇല്ല.
I think it's Rashmi.
Yeah, go on. Yeah.
Done. So fair value is equal to 5 lakh. That itself is an arm's length transaction. So that's why directly bank account debit and the credit financial guarantee liability. Okay, right. This is subsequent measurement as usual, whatever, depending upon the high risk category you said, lifetime ECL, probability, LGD, everything has to be taken into account. Correct. When I have given a guarantee to other party, I must have, correct. Now, NBFC must have not done it so blindly, isn't it? They must have done the bank statement verifications and so many things. Correct. Now, obviously, we are supposed to consider all those things and then subsequent measurement is going to take place. That's it. I did it for with respect to FGC. Okay. Let me take you through one small calculations of some other company. Okay. I don't know 100% how do I make you satisfy, but it may be pretty difficult, right? Let me try. This is with respect to one NBFC company. Okay. Probability of default. It's simple calculation. Just forget about this Excel sheet. If I show numbers, generally always our eyes will go there only. Okay. That's why I just open on sheet 1. Okay. Right. So probability of default. Right. Very simple. Now, correctly speaking, this is the right way. Probability of default. Yeah, yesterday for simple calculation of trade receivables, what I have followed, that may be suitable only for a trade receivable, but not for a loan book or something. Okay, right? It's not the right way. But the standard says what? You are supposed to consider the future impact of the future also. So probability of default PD, what do I do in simple words? Right? What is my historical PD? Correct. Now, what is historical PD? Right. Historical PD is nothing but TTC PD we call. TTC. What is TTC PD? That is nothing but through the cycle. Okay. Right. Through the cycle PD, probability of default. That is nothing but historical PD. Historical PD in the sense what? Again, we will apply our matrix. Okay. Transitional matrix method. What do you do? Yes. We'll, as usual, as we said, say example, this is my basic information. Okay. With respect to a particular party. Okay. I mean, particular set of kind of loan. It's already segregated. Only one segregation I am presenting it to you. Okay. This is a loan given to employed people where the money is coming to their bank account. Because this NBFC gives loan to somebody who is employed, where the money will be given as a cash. No bank transfer is there. For them also, they will give a small token loans. And the second situation is what? We'll give it to employed people where the money, I mean, their salary is going to be directly credited to their bank account. This, again, one more set of people, they'll give it to students also with 500 to 2000 rupees amount of maximum limitation. Right. And they will give it to unemployed people also. They will give a small amount of loans. Okay. Right. So here, whatever the numbers I have provided here, not the rupees. These are all the counts. Because why do you take counts? See, my numbers are, these are all the token of, say, example, 500 rupees loan to 2000 rupees, 500 rupees to 10,000 loans. Right. I don't need to take the total amount here. Doesn't need actually. Okay, so counts how many number of such kind of transactions have happened. Okay, which was 1A to 1A. 1A2 means DPD is equal to 0 days. I mean, it was not a due. I mean, they're all good. 1A to 1A, it was, I mean, after 30 days, also it is in the good condition. Good condition in the sense they have not they not crossed the DPD. That means they have made the payment in time before it becomes due or on the due date. They have cleared their liability. So such kind of loans are how many? If I take a total, there are some 1 crore 17 lakh of totals are there. Okay. At the same time, 1A turned to 1B. What is 1A, 1B? 1A, I said it's a good loan. 1B is equal to 0 to 30 days of DPD, days past due. I mean, number of days crossed after the due date, right? 30 days it is crossed. So how many such kind of loans are there? So some number of loans are there. So based on this information, right, 1 crore 17 lakh, whatever I told you, right? This is a matrix for 1 month movement. Okay, it is just 1 month movement, right? 1A to 1A, when I say, I told we are supposed to read horizontally, not vertically. Okay, that means 1 crore 17 lakh number of loans or number of counts or number of people, I can say, right? They were good. I mean, they did not cross the DPD. They did, I mean, DPD is minus or zero. Okay, they were, and after 30 days also, they were there only. In the sense, they are good people. They did not turn into bad, or they did not turn, I mean, they have not crossed the due date. But okay, that is out of total number of loans is equal to this 1 crore 85 loans. May 117 number of people are very good. And what about 1B? Right, 1B in simple words, this is all our codes. Okay, otherwise nothing else. This is 0 to 30 days DPD. Okay, this is 30, I mean 31 I should take. Okay, 31 to 60 days is this number. Okay, this is 61 to 90 days, and above 90 days is default. Yes, that is norms of RBI. That is obviously NPA I will consider, but anyhow it's a default. This is what is this? This is closed. They clear the loan also in some time. Right. So like this is only 1 month transition, a movement within 1 month. Okay, then what do I do? Right, what do I do? This lifetime cycle, if I want to calculate, then normally the loan period is, I mean, it will change, like 2 months loan is also there, 3 months loan is also there, 6 months loan is there, 12 months loan is there. Right, that is their scheme. Okay, so that's why, so my maximum period is 12 months. So I need a 12 months transition as well. So that's why what do I do? This 1 month transition, I am going to, this matrix I am going to multiply in the sense, for this is 1 month. Okay. 1 second. These are the number of numbers. Correct now default I am going to calculate in percentage. I am going to turn all the my counts into percentage. Very simple. 1A divided by my total. Correct na? Same way I just calculated. So I have got some matrix here. This matrix, this is for 1 month. Perfect. So now if I want to do it for 2 months, I should apply this matrix square directly. Okay, so we obviously will have a Excel formula. We'll apply that formula. If you apply, okay, MMULD, some formula that if you are aware, fine. Not aware, it may be very difficult for me to also explain. This entire, the first one is going to be double. In 2 months, what will happen? Like that, we'll keep on doing for 3rd month, 4th, 5th, 6th, 7th, and 12-month transition will be done. Okay, and then what are we supposed to do? All this information. Okay, I'll bring it here. Okay, so I mean, there are so many kinds of loans are there. I just brought it in one total. Okay, right here. So the same information, the last row of this is the default row. That is what I wanted. I'm trying to calculate the probability of default. Right. This information, I'll bring it in a particular format. Here there's so many loans. I am not directly linking it from that calculation to this calculation. 1 month ka impact kya hai? 2 months ka impact is how much? Like 12 months ka impact is there. So total, what is going to be my summary of all this information? Right. What is that we have done so far? Is historically what is happening. Correct. Now, how do you say historically what is happening? Because if you look at my data, I have taken, correct now, 2020-23 say loan I have taken. If you see, observe my column D1, correct na? Right, 30th April 2023 say, correct na? I have taken it 2025, 31st March 2025. That number of this meaning, this is my data, previous data. So 2 years of complete data we have taken. Why not 5 years? The scheme started only 2 years before. I don't have data before that. So that is what considered. If it was there, I would have considered even that information also, right? So this information is giving me what is my historical PD. This is the fact. Done. So, okay, this is fact is say example, my in simple terms, my TTC PD is equal to say 20% has come. Does it mean that 20% will be there for the next financial year? For the otherwise, whatever the existing loans as on 31st March, so shall I apply only 20%? May not be correct. Why means this may become correct. Now, this obviously may not be correct. Yes, this may not be correct. Why? The reason first. It may come correct now. The geographical changes, economy changes, GDP changes, inflation changes, unemployment into such situations. Correct now. Yeah, some war has come. God knows what will happen. Right. So I have to consider the future projections also. I'm supposed to take it into account. That is PITTD. Yes, Yesh and other people have considered that is point in time a PD, probability of default. Yes. Macro levels, macroeconomic factors are supposed to be considered. Again, when you are picking the macroeconomic factors, what are your macroeconomic factors? See, what makes sense only supposed to be applied. Just because there are macroeconomic factors or hundreds are there, okay, right. Again, sometimes what happens if you take too many macroeconomic factors into my consideration, okay, right, it will not give the real picture also. That's why while selecting the macroeconomic factors also, you have to be very cautious. Okay, in my situation, in so and so company situation, we have considered only two macroeconomic factors. One is GDP. Okay, the second one is inflation rate is considered into in my calculations. Okay, so how do I calculate that data also? Yes, there is a, I mean, too much of, I mean, calculations, Z factors, so many things will be there. I don't know to what extent I can make you understand, but I'm just giving a try. Okay, see, these are the two factors. One is GDP, one is inflation factor we have considered. Okay, what is the percentage? From where you got all these numbers? Okay, from the, this is Indian GDP, obviously. So it is available, right? In the IMF website, if you look at, yes, for our country it is available, for Dubai also it is available, every country it is available, right? This is still 30th September 2024 information is available. Okay, right. Subsequently, what is this data? How did you get? These are the projections by IMF, right? It's provided by them, not by me. Okay, so what are they expecting? Their expectation is this is the GDP, the future. Okay, this is the inflation rate of our India is, this is the information. Okay, so then what do? Then I do the mean, then I do the standard deviation of this, right? Mean and standard deviation I'll apply obviously for the past data, not for the projection, right? So this is the mean of all this information, whatever I could get it, right? What is the standard deviation? We know standard deviation, my mean is 6%. So it can be plus 3.65% or minus 3.5%. If it is a good it is a good forecast. If it is a good forecast, my GDP of the country will go up. Correct now. Or if it is a bad forecast, it may be falling down. Correct now. So from where to where we have this 10%, how did you get? Yeah, this 10% we got it. This is the projection by them. That is 6.6, 6.46. Plus 3.65 if I apply, I'll get a good forecast. And the worst minus way is this another bad forecast. Okay, what is the basic jet score calculations? Right. So all these, after application of this, again a correlation calculation is supposed to be taking place. Right. After correlation application and Z factor and one more standard way. What do we say? Like generally 68% of what we say, there is 68% of probability that current economic condition of the country will remain same in the next 12 months also. 68% is the standard way, okay, for a well-doing country, right? So what about the next? That is 16 and 16. This is a base, I can tell. This is the base method, and this is something good I can consider, and this is the, a bad situation I can take it into account. What do you mean by 16% is here? 16% is a chance where it can be better than the current economic factor in the next 12 months of period. Okay, bad in the sense it may go down. That 16% chances are there to go down. So all these economic factors are supposed to be considered. Then only my ECL will be calculated, right? But as I already told you, this level of exercise and so much analysis of data required for such kind of companies, not for a general routine trading manufacturing company for trade receivable. This much of great deep analysis may not be required. Okay, right. So this, with respect to this, if there is any question till this extent, you can ask, or towards the end also we can take it up. Okay, right now let's listen to Satya Bharat.
Yeah, thank you, Mr. Ravi. Hope my screen is visible.
Yes, yeah. Yes, Satya.
But I doubt after going through this much of detailed statistical analysis and ECL calculation for NBFC, how far people are interested on the corporate tax. So shall we start on corporate tax discussion? Just like the topic is on interlinking the IFRS with the corporate tax provisions. Can someone give me where and all, as per your knowledge, the corporate tax have touch based on the financial instruments, be it financial asset and financial liabilities? What are all the provisions that are covered for this? I would like to get some answers. The areas. Transitional, perfect. Any more places? MD 134. Interest expenditure allowability, no. Straight from the financial assets. Fine. Let me start discussing on these points. Sorry. So transitional provisions, the one area, a realization basis and transfer pricing compliance. Let's start with the transitional provisions. Hope you all aware what are all the assets eligible for the transitional provision benefits. But before that, some of you might have already filed the returns, right? And you must have chosen that you want to go ahead with the transitional provision for immovable properties, for intangible assets and financial liabilities, right? How many of you have already taken? Do you think we should opt for this or we should not opt for this? Okay, so that is the topic what we are going to cover now. Let us take a situation. Illustration 1. A scenario wherein I'm going to take up two illustrations. Let us decide whether we should opt for the transitional provision benefits exclusively for the financial assets and liabilities. Is it really making any sense or will it not make any sense? So that is a points we are going to cover. For before that, we'll just have a look at this first illustration. On 1st of January 2023, before the corporate tax period, ALLC has invested 1 million in a plain vanilla bond carrying 5% annual rate. And the date when it has purchased the bond, the rating given to this bond is AA. Fine. The second point. Yeah. As per its investment policy, ALLC will immediately sell a financial assets if its credit rating falls below AA or if the company is in requirement of funds. So these are the two situations that company will sell the bond and it will realize the money. Otherwise, the business model is to hold till the maturity. The business objective is to collect the contractual cash flows from the bond. So I would like to hear from you, is the business model test and contractual cash flow test is met in this case? You can say yes or no. Business model test meeting in the sense the contractual cash flows should give them the collection of the contractual cash flows. The characteristic test is whether it will give only the principal and interest. Fine. Yes. No. Fair value through OCI. Since both have been fulfilled, both the conditions have been fulfilled, we'll be going with the amortized cost. The purpose, we understand amortized cost, meaning any fair value changes will not be touching the P&L or OCI. We will carry at amortized cost irrespective of whatever happened to the bond, unless it is an impairment happens. Now, on 1st of January, now the tax period has started. On the 1st January, due to some market interest rate fall, of course, when the market rate interest is down, the current bond market, our current bond is giving 5%, so people will be interested to buy the higher rate interest, whichever the bond which is giving higher rate of interest. So the bond price have shoot up to 1.1 million. So there is a change. 1 million is the actual original cost what we have purchased, but in today market, like it is available for 1.1 million. Do we reflect this change? We will not reflect because this is amortized cost. Now, the second one, on 1st of January 25, there is further dip. The bond market value, the value of this bond increased to 1.25 million. Because of some reason, the rating shot down to single A. So the company has sold it and it made a profit of 250,000. I repeat, company sold on 1st of January 25 for 1.25 million. It has actually purchased the bond for 1 million. So there is a book gain of 250,000. Hope everyone clear. Now I want to understand from you, what is a taxable income in 2025? So to make it more better, I have also kept like this. The same facts, carrying amount 1 million, original cost and net book value also, because we are following amortized cost. Number 2, market value as on 1st of January 24, the first day of the first tax period, is AED 1.1 million. Let us discuss on the scenario 1, wherein sale consideration is 1.25 million and book profit they made 250,000. Is the entire amount taxable? Scenario 2, wherein the sale consideration they sold it for a loss of 100,000. So can they claim this loss as an expense? I mean, while adjusting for the taxable income. For this, to evaluate is it good to take transitional provisions or not, we are going to have scenarios. So before I answer, I want to hear from you. Scenario 1A, wherein the company made 250,000. On the other side, it also taken the transitional provision benefits. Hope most of you know what is transitional provision benefits. For a financial liability and financial asset, as per transitional provision, the first day of the first tax period, you take the market value. So in our case, in the current scenario, it is 1.1 million. So any movement from this 1.1 million, you will get the benefit. Meaning, if you sell for 1.5 million today, only you will be taxed for 400,000. However, if you sell only for 800,000 instead of 1.1 million, then 300,000 will be allowed as an expense. Hope everyone clear on that. So now coming to this, the taxable income in the scenario 1, 150K is taxable. Okay, let us see. 150K is taxable. In the scenario 2, where the transitional provisions are not opted for, if it is not elected, in scenario 1B, what is your take? If I have not taken, obviously my book profit, entire book profit will be subject to tax, 250K. Scenario 2, wherein I sold it for loss, but I have opted for the transitional provision benefits, meaning now my book profit, I don't care. I'll look from only market value as on the first day of the first tax period. So 1.1 million minus 900,000, 200K, I'll get the benefit. The last scenario, only 100K I will be getting. So by looking at it, can you tell me, is it worth opting for the transitional provision benefits for the financial asset and liability? Do you think yes? Okay. Hold on to your answers. Let us see illustration 2. That's illustration 1. Let's talk about trade data. That was a different case, quoted bond, where there was no ECL, no expected credit loss. We were carrying at the amortized cost. Everything was good. But now let's take a different scenario, illustration 2, where there is a trade debtors, carrying amount of trade debtors as on 31st of December 2024, 2023 or 1st of January 24. And there is obviously, we have to calculate expected credit loss as per IFRS 9. that we have provided for 200,000. Net carrying value in the books, of course, we don't write it off, but for the debtors, if you see when we are presenting like removing and we are showing it in this presentation style. We have not tampered the historical cost. The trade debtors carrying value still in the books at 1 million. We have not made any adjustment. This is just for the presentation. This is how we have shown. So net carrying value, we can assume as good as a market value. As on 1st of January 24 is 800,000. Same scenarios, let us take scenario 1, wherein we got the entire money. We were expecting 200,000 of loss, but then our debtors are good. They paid the 100% amount, 1 million we have received. Obviously, the excess provision, excess ECL, what we created, we will reverse it. These excess provision reversals. So that will become your income. Scenario 1. Scenario 2, wherein we have lost even 100,000 more. So we were expecting at least 100,000, 800,000, but we got only 700, meaning there is an additional bad debts written off. So let us see in this case, is it worth taking the transitional provisions or not? This is the most common scenario for us. Okay, the same situation, scenario 1 where 2A, 2B. So 1A, wherein we got the 100% amount what we are supposed to get irrespective of the ECL. Though we have the ECL, our creditors are good, they paid us entirely, and we also reversed our excess provision. So in this case, what do you think the taxable income in the case of 1A? You can mention 1A and you can give your answer. Gain 200,000. 1A, can I get some answers, please? Sorry. Okay. In the case of 1A, it is 200,000 because your entire ECL, I mean, from the market value, whatever the amount, assuming market value is 800,000, because you have complied completely with IFRS 9, if you can assume that as the market value, anything that you get a benefit or the loss, you can take it as for the tax purposes. However, even if you don't opt for the transitional provision benefits, still you will be getting it. When you go with the scenario 2, the impact is the same. So I mean to say financial assets, financial instrument, financial assets and financial liabilities, when you have already matched your buy in the form of ECL, expected credit losses or impairment losses, if you have already matched it to the market values on 1st of January 24 in the books, even I'm not saying historical cost is still continued. In such case, it will not make any difference whether you opt for the transitional provisions or not. However, the other cases, the other assets where you are carrying at amortized cost without having any ECL in the books, those are the cases where you will get the benefit. So transitional provisions are only to give the benefits. So it is good to go always just tick blindly because it is not going to harm. It is always going to give the benefits. Either it will make a neutral situation. Whether you opt it or not, it will make a neutral situation. Okay. So any questions on this transitional provisions? 1 year, 200K. Okay, fine. Thank you. Next. So transitional provisions. Then the discussion is on the realization basis of taxation. As you know, we have 3 choices are given. I hope you all remember this 4 different scenarios we have seen for a financial asset, how many ways we can classify, 4 different styles we can classify, and subsequently each of these asset will subsequently measure a different style. For example, an instrument which is carried at amortized cost, no fair value changes. We don't care. We always carry at the cost, less any impairments, less any amortization, depreciation. In the second case, where we will take the fair value changes. Fair value changes, I mean to say, from the date of your purchase to the year end. The difference, the value difference will be taken to OCI reclassified. And the exception 3, OCI non-reclassified, and the assets which are classified fair value through P&L, the movements, the fair value changes, unrealized will be taken to P&L. Same likewise for the impairment gains and losses. So we don't care about OCI reclassified. OCI, those items which are taken to OCI and which will be reclassified to the P&L for the tax purpose, ignore for now because they don't want to touch at this point. They want to tax on this when it will actually reclassify to P&L. So the year in which this will see the face of P&L will be taxed. Otherwise, till then they don't care. But Article 2(1) of MD 134 only bothers about OCA non-reclassified. So I have not even highlighted that. Now I'm going to talk about in the next only those which are now rounded or captured. So three different scenarios where the first one blindly go with the IFRS proposition, or there is one more option given in corporate tax. All your assets and liabilities which are subject to fair value, which are subject to impairment accounting, enjoy realized basis taxation. Meaning, if there is an asset which is subject to fair value, very good example is investment property. So in investment property, because it is subject to fair value, unless you sell the asset and get the gain, don't pay me the tax. I know you have investment property as per IAS 40, you have to fair value model you may be following, and every year the fair value changes, you are recording in the P&L. I'm not interested in taxing that, nor that I'm going to give you any expense. Fair value reduction also, I'm not going to give the benefit. So you carry it till you sell this property, and when you realize the gain, only then you come and pay me. Till then, you can enjoy the realized basis taxation. Likewise, for these financial instruments, different scenarios, the one that is highlighted, if you go by default with the IFRS model, all those which are highlighted in the red are taxable. All unrealized gains and losses are taxable, except OCA reclassified. OCA reclassified need not be offered for the tax at this point of time, at the current year. In the second case, all unrealized gains and losses are not taxable. And in the third case also the same. So financial instruments, basing on the way how it is being structured out of them, in which bucket you are keeping it, the realized basis taxation will also have an impact. Any questions at this point? Yeah. If AC was at unrealized loss. No, amortized cost we don't touch. Unrealized loss only could be the impairment losses. Unrealized losses can only be the impairment losses. That is also I have covered over here. You can see it. Impairment losses, even then if you opt for the realized basis, it is not hitting your pocket in just if it is a simple allowance, so it is not allowed for the tax purpose, even if it is amortized cost. And there's one more question. Basically, if we are collecting the full amount and provision exit for the DD. Okay, DD. Okay, let me come back to you on this. Fine. Now coming to the transfer pricing compliance, as we know, all the like the last 2 days we have seen non-financial assets, non-financial liabilities, which are carried at non-arm's length standard, meaning with a related party you have purchased a PPE, except in the case of IFRS 16 sale and leaseback. I repeat, except in the case of IFRS 16 sale and leaseback, rest of the cases, the off-market transaction need not be captured in the books for a non-financial asset and non-financial liabilities. However, for financial assets and financial liabilities, we have to give the effect of any off-market transactions. We have seen multiple scenarios. For example, an employer giving loan to employee. Say, for example, a company giving loan to connected person payment. For a connected person, interest-free per visit, interest-free loan as a per visit. We have to do the benchmarking of the borrower, the connected person, and we have to do the necessary changes. But that is not only the requirement of corporate tax, it is also a requirement for the IFRS. We have to do the benefit that we are passing should be considered as a prepaid employee benefit expense and have to be amortized across the tenure of the loan. Likewise, if you take a shareholder or a parent company giving loan to subsidiary company, we will be doing the benchmarking at the subsidiary level, the borrower level, and that will be considered for the corporate tax purpose. But that is also a requirement for the IFRS. The difference is, if we just go with the corporate tax, they will apply the rate of interest on the entire amount. However, with the IFRS, it is assumed, it is deemed that the loan extended is already inclusive of the interest. So we'll do the reverse working. Hope you all remember the way that we have made the calculations. And that is how we'll be recognizing the interest income in the books of lender and an expense in the books of borrower. However, the day one of the loan given, the difference, the fair value and transaction price difference will be taken to the investment in subsidiary or capital contribution accordingly. Same is the best part is when subsidiary giving loan to the parent company will recognize the dividend income. If participation and interest is fulfilled, then this dividend, what are the benefit it is going to enjoy, will be out of the tax. Sister concerns, we have seen it will be a pure income and expense you will recognize on the day one that is offered for the tax. However, overall, if you take the tenure, the entire tenure of the instrument, the loan, it will be nil. The impact is zero. So if we really follow IFRS 9, then corporate tax, whatever the at arm's length adjustments we do, will have a zero impact. I repeat, if IFRS 9 not followed, if we just going only with the corporate tax adjustments, not completely following with it, then you will be considering the interest in one books and expense in the other books. If you follow IFRS 9, then it is like we have complied with the corporate tax, we complied with the IFRS, and number three, it is a neutral. The overall tenure, if you take, the impact on the P&L balance sheet is going to be neutral. The day before yesterday, I have shown one illustration how it is going to happen. Finally, the topic what we have discussed today, financial guarantee given by parent company to subsidiary company have to be captured. What we generally do the benchmarking for that 2% or 3%, and accordingly we will apply. But this is not just a requirement for the corporate tax, this is a requirement for the IFRS as well, which have to be captured as a financial liability, and it has to be amortized as an expense. So any questions so far interlinking, I'm happy to take. Can you summarize this, how best to use the transitional provision from financial asset? Slightly confused between ECL and process NTM. A transitional provision for a financial asset, see, mark to market, amortized cost again, the amortized cost will not be touching. Let me see the financial assets. Okay, you're talking about in general financial assets. See, these are the financial assets. Let me take on this broad classification. Okay. So let me first talk about these three situations. These three situations are fair value through OCI, fair value through P&L, meaning you are adjusting the fair values. The moment you have touched your historical cost, you lost the benefit of transitional provisions. So for all these financial assets, you will anyway, we will anyways not get the benefit of transitional provisions because we must have changed the historical cost and match it with the market. So we will ignore this. Now I'm talking about this scenario only for the amortized cost. In the amortized cost, again, you have two type of, for example, you have an asset where you already calculated the ECL. ECL only. You have not made any changes to the historical cost. You have created the ECL, expected credit loss. And there are certain other financial assets like bond investment in the bonds where you have not created any ECL. So for this kind of assets, your transitional provision is going to be helpful. For the assets where you have already created some ECL, expected loss allowance, so it will be neutral for you because it will not make any difference whether you opt for the transitional provisions or not. For the other assets, it will not anyways applicable. Hope I'm clear. ECL is there on bonds also. I mean to say, for those instruments which you have not calculated the ECL, if you have calculated, I'm putting that bond under this category. So the other bonds, I mean to say, the assets, financial asset, which have not been created for any ECL because of the your own loss allowance provisions, you have not created for those assets. If it is created, I'm looking from this point of view. It will not make any difference for you. Or maybe if you have created the ECL but not in line or not matching with the market value, still you can get the advantage. Yeah, if there is any more questions, I'm happy to take. Otherwise, we can take up to the next topic. Okay. So Mr. Ravi, you can go take up the next topic.
Yeah. Thank you, Bharat. See the last topic, what is left over? Just let me 1 second. Yeah. I think screen is visible.
Yes.
Yeah, thank you. Presentation disclosures of IFRS 7. See, I know that time we need to give some 10 to 15 minutes minimum of for the question and answers. I am covering this very briefly. Okay. See, the presentations disclosure, this is not something new, right? Overall, I would like to cover it up. Right. So disclosures that about the significance of financial instruments. Right. Before going to the disclosures which are required by IFRS 7, one general note which is there in the right, say, let me go to the IA Ind AS 1 or IAS 1. This is the same paragraph reference of IAS 1. What it says, material accounting policies are supposed to be disclosed. That is the amended standard IAS 1 talks about. The particular paragraph, because of this, so many places the IAS 1 got amended. It says very clearly, whenever you give the accounting policy information, whatever is applied by your company, that much is supposed to be given, not the repetition or duplication of what is supposed to be done by the IAS or Ind AS. Right. Generally, why am I telling? Whenever I see any companies, that is the problem from the management side also. Obviously, I agree. Management also won't agree for some substantial change. Right. If you see any company financial statement with respect to financial instrument, they will start writing. We recognize financial asset, 1, 2, 3 heading, financial liability, impairment of financial asset or impairment of non-financial asset. What is there in this information of accounting policy? What is there in the standard of IFRS 9, IFRS 7, everything copy paste job is only there. Correct. But actually the requirement of IAS is only what your company is applying. It's a simple example I would like to say. Say IAS 2 inventories. Correct. With respect to inventory, what is the disclosure of accounting policy that you expect? What should be there? Generally, what do we write? We'll write so much. Our cost includes 1, 2, 3, 4. Correct. Na? At the same time, later we will say, I am following if either FIFO method or LIFO method or weighted average or whatever the method you are going to follow. Agree? Right. But exactly out of this entire description of first 3, 4 lines, you talk exactly what the standard is talking. Nothing new. Right. What is required by the standard is what is your company's policy. My company's policy is only one, that is FIFO basis. That is exactly what is required. If you see any 10K of Apple company, correct? Seriously, I love to see the financial statements of Apple. Right. Earlier, maybe in one of my posts in LinkedIn, I mentioned that was actually the accounting policies. It has come in one page. It's like wonder, I feel. Like they wrote like inventory, they said, obviously they do have a lot of inventory. We do follow FIFO basis. One line, over accounting policy. Right. Our accounting policies will run into 20 pages, 30 pages, which may be not useful. Right. That one needs to look at. Right. Chalo, let's come back to our standard IFRS 7, the disclosure. What is standard is asking, like as I told you, this overall disclosures I am going to give it, and we can utilize the remaining time to answer your questions related to first day, second day, third day, any day, whatever our level possible, we'll try to answer that. So the first thing is like carrying amount of each class of financial assets and financial liabilities. Yes, that is going to be presented correct in the face of financial statements. Yes, that is required. Obviously, we'll write very clearly. Right. In India, we'll say like under financial assets heading, we'll keep the numbers. Yes, in as per IFRS, it is not required. That is India specific. But when you look at countries in different countries' financial statements, we don't mention anywhere that is a financial asset or financial liability, a separate heading. Directly, we say this is a trade receivable, this is the loan taken, or this is the loan asset. And yes, when you go to the schedule level, then we'll explain it in detail about the same. At the same time, income, expenditure, gains, losses related to this financial instruments, whether it is routed through profit and loss or whether it is routed through other comprehensive income, right? And it should be provided in the notes to financial statements. Okay, next, what are the accounting policies with respect to financial instruments? Yes, say example, wherever you have got it, see, accounting policy is something, whenever you say it's a policy, I can simply say policy is a choice. where you have a choice and what choice you have taken out of the available things. That choice you had taken, that should be provided. Okay, see, for the financial instrument, if you go deeper and deeper, correct now, right? What is the trade date accounting and settlement date accounting? That is also is there. So today I purchase a share in the market. Today I trade it, but actually settlement is happening T plus 1 or T plus 2 days. You have a choice. I want to follow trade date. Today only I'll book the asset and today only I'll consider the fair market. I mean, on the 31st, suppose something is purchased on 31st March or December 31st. I can book the asset today itself, even though it is not appearing in my demat account. The next option is available to you, settlement date accounting. Right, it is going to be settled on 1st January or 2nd January or 1st April or 2nd April. Then I say I would like to recognize that specific asset only on 2nd April. Right, but subject to, again, fair value change should be considered. If it is amortized cost, not required. Right, so there is a choice, trade date accounting or settlement date accounting. Then you should say, okay, my company would like to follow trade, or we are following trade date accounting. That policy is supposed to be taken. Wherever the standard has given a choice, there you need to present your choice. Okay, that is what your accounting policy basically. Transferred financial assets. Yes, we have transferred, but we have not de-recognized. If you remember, right, I said there is a continuing involvement. That's why we said continue the financial asset. At the same time, you have to recognize the liability. Right, that information specifically you are supposed to provide if there is any with your company. Okay, whatever the collateral pledged, that is normal, correct? Whenever you have taken any loan, a secured loan, obviously we'll be giving, these are all the collateral information, correct? Collateral for your liabilities or any contingent liabilities also, all that information has to be provided. Okay, right. At the same, collateral held, right? I mean, you sold, I mean, somebody pledged for me, correct? Now, I mean, with me, right? That information also has to be provided. If the fair values are supposed to be mentioned, yes, depending upon the standard requirement, you are supposed to do. And the next important thing with respect to disclosure, impairment allowances, which is nothing but ECL. Okay, ECL on the financial assets, yes, including the reconciliation for the change in this asset, correct? Now, what is the opening my ECL? What is the current year reversal or current year charge, and how did we derive the movement? Basically, opening to the closing ECL is supposed to be provided. Okay, and if you have got a compound financial instrument, on day one we have discussed few of the things, correct? Now, what is a compound financial instrument? Where one instrument has a equity element as well as a liability element. That is compound financial instrument, embedded derivatives, all that information, correct? Now, how did you have you bifurcated the liability and equity component? If you have multiple embedded derivatives, right, were you dividing it or not dividing, subject to the rules of IFRS 9 and IAS 32, right? That information you are supposed to disclose, right? And if there is any default and breaches of loan agreements, yes, right, that again there is an exception to this concept of like IAS 1 with IAS 10, right? If there is something is defaulted and even though it got rectified, it is defaulted as on balance sheet date. Suppose a financial covenant. Okay, financial covenant, I have taken a loan. A financial covenant was there, like I have to maintain so and so percentage of current ratio or return on investment or whatever it is. Okay, it may be performance or it may be anything. Perfect. I could not do it as on 31st March. Fine. So now if you do not do, what is the implication? If you read the terms and condition, it says you are supposed to pay immediately. Then actually my actual liability is going to be a long term, say after 3 years, I am supposed to repay. But if you do not satisfy this financial covenant, it may be you are supposed to pay immediately. But in the month of April only, you went to the lender and you got their consent, you explained, you gave your excuses, whatever it is, it got rectified. But still, as on 31st March, it was correct. Now, the other party had a right to collect it from you. That's why it must be presented as a current liability, not as a non-current liability, even though that is rectified subsequently before signing the financial statements. Still, correct. Now, that information is also supposed to be provided here. Accordingly, the classification has to be taken care. right? Not only in addition to this information of, impairment losses and classification, collaterals and income, expenditure, assets and everything. In addition to this additional information disclosures are supposed to be provided. One more important point which will come, right? Any financial statements will give on the top, that is after basis for preparation of financial statements or consolidated financial statement. First we'll give that the estimations, management assumptions, the significant assumptions and estimation, one column will keep there. Wherever you have taken a fair market value calculations, nowadays the fair value will be there everywhere, correct? Now what are your assumptions, right? If the financial asset or financial instrument is so significant, right, obviously you must have taken fair value assumptions. If it is other than level 1 category of IFRS 13, correct, that is obviously going to be significant estimation or assumption. That information, that paragraph, we need to insert, under the main heading of assumptions, you need to please insert this is going to be, because fair value is a one kind of judgment, correct? No? That's the reason, right? Next, in addition to this, what is the credit risk that the company is involved? What are the liquidity risk the company has? How they are going to manage such kind of liquidity risk, market risk concentrations, change in the risk exposure, so much capital management, right? Sensitivity analysis of the fair value, right? So much of information is supposed to be provided. Okay, this is overallly the presentation disclosure part. Okay, right, we are actually left with hardly 15 minutes approximately, so I would like to close it at this level, right, and open to the questions. Thank you very much. If any case, if we have missed out some question in the past.
There is one question for Ravikant, I think. In the chat box.
Yeah. Yesterday Excel sheet, okay, one. What are the specific tax disclosures are required in the financial statements of UCIT? And Bharat, I think you can answer this. IS 12. Perpetual bonds, do we need to calculate ECL? Yes, perpetual bond is an amortized cost. A debenture at amortized cost, measured at amortized cost. Yes, it is you are supposed to perform ECL calculation. No exclusion. Okay. Do you foresee any challenges in FTA for this treatment for the first year? Bharat, would you like to take up?
So which treatment? Is it like transitional provision treatment or the difference between the fair value and the transaction price? It would be better if we can get the exact clarity. Foresee challenges. Transitional.
Transitional.
So in writing, anyways, we have got it like ministerial decision number 120. So it is we have to match with the market value. The only challenge is the market value, how you have arrived the market value. That could be the one question. So basically, I have a trade debtor, which is a financial asset. With the trade debtor, I can go to a securitization company which can buy out my trade debtors. I can go to a bank and I can also transfer it to some other party. So everyone has their own style of purchasing. So the negotiations will be different. So for that reason, I'm complying with my ECL calculation basing on the historically what is the probability of receiving it back. So I assume once I comply with IFRS 9, I assuming it to be the market value. So the moment I can match with the market value, any moment from there, in the sense like any upwards, if I get more than what I'm expecting or less than what I'm expecting, that is the amount that I can take it for the tax purposes. And I don't see any challenge in that, as long as we have the documentation for the IFRS 9 ECL calculation.
Yeah, with respect to PPTs, yes, surely we'll share the PPTs and the Excels. That Excel sheet, whatever I have presented it to you yesterday, that also I'm going to share it with the team. You are going to get that. So since it has all the formulas and it's not a keyed-in number, everywhere I have mentioned the formula. That will be, easily understandable, self-explanatory. Okay. right? Ish, yeah, earlier question on FET OCI to AC bond change in classification. Say the value in book is equal to 90. Okay, FET OCI to amortized cost. Okay, agree. Current value is also 90 when it is being reclassified to amortized cost. Agree. So what will happen to AED 10? That is minus 10 mark to market, which is currently in the OCI reserve, right? So if it is in OCI reserve till the time of settlement, of that, this will not be touched. It will continue to be, yeah, it will continue to be in the FET OCI itself. I mean, in the specific reserve till it is closed. I mean, closed in the sense settled, sold off, disposed. Till that time, it will continue in the same reserve. Just because of your current reclassification, your transfer to amortized cost, that will not be moved to profit and loss or retained earnings. Okay. Yeah. Next point is I understand from the EAD computation, it would be funded exposure plus any headroom. Okay. How is this example undrawn loan amount or guarantee converted into EAD? That is what factors would be used. Maybe very difficult to answer at this time. All right. A little more information is required. What is his name? Yeah, Rahul Shah.
Generally, for the undrawn loans, so it all depends on the your contractual terms. If you are, if the party, the borrower has every right to collect it back, then you have to consider even the undrawn loan also for the ECL.
It's not easy. Is ECL to be done on cash and cash equivalents? Obviously not required. In case of overdraft, as an example, there is a limit and there is a draw. Okay, Rahul Shah is trying to answer. But Rahul is saying.
Yeah. So undrawn amount. I mean, the drawn amount depends on depending on the contractual terms. If the borrower has every right to take this undrawn portion with unconditionally, then we have to consider even the undrawn portion.
There's one more question if you want to look at.
Yeah.
What is the
Yash
treatment?
question is,
Yeah.
Yash questions is what is the treatment of sale of hedge against a bond before maturity of the bond or vice versa? Okay, basically, okay, if it is undrawn limit is irrevocable, fine, that is different question, I feel. On a FET OCI bond, which has hedged through an IRS. Okay, interest one. I think Satya, hedging related.
Yeah, so we'll come back on the hedging part.
If there are any other questions, I think you can just.
But just to understand, Mr. Yash, the sale of hedge you mean to say, so there is a bond purchase it, which will give you fixed rate of interest, against which you have entered into a interest rate swap, wherein you pay variable and you will, sorry, you pay fixed and you will get the variable, right? So you have two hedged item, which is the bond, and hedging instrument, which is the interest rate swap. So you mean to say interest rate swap have been cancelled or revoked or sold before the bond is sold? I mean, the bond period is 5 years, but interest rate swap is only for 3 years. Is it something of that sort? This bond is fixed rate and IRS is for conversion for fixed rate. Yes, we sold it before the bond maturity. Actually, when you have hedge item and hedging instrument both, so both will be carried through the P&L. So, so uncovered part, yes, we sold it before the bond maturity. Okay, so you sold it in the sense you have the contract itself, the value in value or the term itself is worth 3 years or the shorter term than the bond maturity. So in such case, skill only done run 104 OCA, which was hedged through areas. Let me come back to you on this. I got the question, so let us come back to you on this.
Yeah, Midhu is asking whether the forward exchange contract which we entered, should it be shown in the financial statement? Yes. On the date of when you have entered into an agreement, the value of a forward exchange contract is nil. So that day, no journal entry will be recorded. Right. This forward exchange contract on 31st March, based on your position, are you in a gain position or a long? I mean, are you in the money or out of the money, whatever it is? Are you in a positive? Then it is going to be a financial asset, or it is going to be a financial liability. Yes, that information, it is supposed to be, you are supposed to recognize the asset or liability. At the same time, disclosures also required.
Yeah, I think during the session itself, we covered most of the question and answers. Probably that is the reason why we have, or at least lesser questions at the end. We have another 5 to 6 minutes more. If
Yeah.
you have any more questions, yeah.
There is one more question from Rahul Shah. If a loan disbursed by a banker is measured at a FTPL, okay, fine. That is as per SPPI test failed. Fine. Right. Any facility fees that's not yield enhancing, how should that be treated? Are you asking from the loan asset basically? It's a loan disbursed by the banker, so it's a financial asset to the banker. It's measured at FVTPL because of his PI test is, then it is supposed to be transferred to profit and loss statement. Any transaction income, see, it is always, as we discussed, it's based on the classification. If it is FVTPL classification, you are concluding, yes, it is going to be transferred to profit and loss.
But it is very less likely that SPPI test can be failed for
Correct.
a bank.
In the given question,
Rashida madam, like you are right that unless hedge accounting is elected, if hedge accounting is elected, then part the gain or loss in OCI. But again, depending on the cash flow hedge or fair value hedge. If it is a cash flow hedge, you are absolutely right, OCI. But if it is a fair value hedge, then we'll take it to the P&L. What about call options? How do we account them for year end if not exercised? So it will be always empty mark to market call options.
yeah, it will be it is FVTPL classification basically. Every derivative is going to be classified as FVTPL. No other option is available. So mark to market, yours at the year end, it is supposed to be done.
So there is no question on the shareholders' current account. Rankanji, so there is one specific peculiarity of accounts that are maintained in UAE. I'm sure like you must have not heard something called shareholders' current account, which we never
Okay.
ever do. Yeah, like how that must be the word, the terminology which we use for the sole proprietorship or maybe for a partnership. While here there is a commonality wherein the funds will be injected and taken out from the shareholder very commonly, and the name that is given to it is shareholders current account. It is acceptable across all the industries, and be it big fours or whomsoever, they accept that, and that will be very much visible from the financials, audited financials, whomsoever it issue. Very few people they classify it as a bonus I mean, they call it as a bonus contribution, but otherwise they upfront call it as a shareholders current account. Again, there are two layers. Few people will classify, put it under liabilities. They will classify under liabilities, and some of them are classified under other equity.
Okay.
So this is a very common accounting. So that is a one area to be discussed at length, because now given that transfer pricing regulation is coming up, whether this shareholders current account, if it is a credit balance, do the shareholder need to be paid with any interest, or if it is a debit balance, do the company need to charge from him? So that is a kind of discussions are all across. And
Oh.
the other side is because he takes in and out, it's like a current account wherein he has every right to claim. So in such case, how we are giving to the people, the moment it all depends on the way that you're classifying in your financials. If you are putting under other equity, and also there is no claim from the shareholder, that he cannot go to the company and ask for it, then it's a pure other equity. Just go, no need of any interest to be taken for the purpose of corporate.
Exactly.
While if you classify by you yourself classified under your audited financials under liabilities, meaning you are accepting that they have every claim, the shareholder. So you have no choice but to do the necessary adjustment for the corporate tax.
Oh, okay. So, and I mean, there is a possibility to ask for the money back, is it?
No, it's like a class. Of course, even though they classify under other equity, they will club along the share capital, reserves and surplus, retained earnings, current year earnings, and one particular in other equity, you will see this current account. So there will be a movement. There is always a net movement will be there. In spite of that, it is under other equity. If it is under other equity, there generally there should not be any movement, except that he pumped in the money and he has to take it only in the form of a dividend. But then there is always inflows and outflows. For CT purpose, yes, Mr. Rishta ji, yes. Shareholder loan payable on demand, they can escape the treatment from the IFRS, but then for CT purpose, we have to take the 3 months labor. Generally, when we do the benchmarking, we can go for the lowest 1 month labor or 3 months labor, but it is inevitable. So generally, what we are doing is for the monthly average balances we are taking. Even though it is on demand basis, we are taking the monthly average because we are doing on a historical. For 2024, at the end, we are doing on a monthly average and basing on the borrower's credit profiling.
What about quasi-equity? What is your opinion on quasi-equity?
That claim, like quasi-equity, that's what I was just explaining, Mr. Ravi also. So quasi-equity in the sense you yourself accepting that characteristic. You want to take it to the equity where the borrower, the lender has only residual claim over this money, or he has every right to claim back from the company by giving a notice.
Mm. It's like, Mr. Ravi, it's like, here in UAE, it is that account is considered to be settled at the last. So if there is a cash flow crunch, the shareholders puts in money. It's more like working capital shortfalls, whatever is the working capital shortfall. Ideally, the shareholder puts in the money. As and when if there is cash flow, they will remove it also. It's like an account which is parked basically. It was termed as current account for all the years. Now with
But is it
sudden
a right to them to take it back, or is it
um,
wish of the company?
uh, actually, he's the one who drives the company here. Most of the time, there are either one or two
Okay.
people driving the company. So it's at his will. There is nothing in the law, nothing in this MOA which restricts that they cannot withdraw. That capital is different. It's defined in the memorandum. So that share capital is defined in the memorandum, which is a certain
Okay.
amount. So that amount is parked as share capital. Besides that, any amount which are like shortfalls for the business running day to day, the shareholders pitch in the money. If there is something
This
left, they would take it out also. So there was nothing like declaring dividend, retained earning. These concepts have just been highlighting now. Not that companies don't follow. Many companies do follow declaring dividend at the end of the year, retained earnings, settling the balances. But there are a lot of companies, especially SME sectors, wherein you'll see this that the shareholders don't withdraw their balances, and it is there lying for years. So even if you go back and check, the opening balance must be there for like from the time the companies have started.
this is actually a new concept to me.
Yeah, it's a UAE concept
Yeah,
Yeah.
only a concept.
of
Yes.
Yeah.
accounting.
Yeah. If any of you have any questions, you can, I think, unmute and ask also. I think now it is open.
The
Yeah.
best part with India is in India, Section 185 Companies Act of 2013 does not allow for the loan. Number two, if you take any loan from the Income Tax Act 2 Clause 22E, if you take any dividend from a closely held company, the moment you take a loan by directors, it will be deemed dividend, so taxable. So this is
Yes.
the reason why we don't touch tamper there in India. Either Companies Act not allow, prohibits. Number two, even if you close everything and if you still want to go ahead and take it, it will be a taxable element, which is not the case. So that is how the movement happening here.
Okay. Okay.
So, can I ask a
Yeah,
question,
but
Satya?
uh, yeah, sorry, go ahead.
Yeah, no, it's on the same interest. So, if shareholders' loan is a liability and repayable on demand, and you charge interest on the corporate tax purpose, so basically, government is giving you a tax deduction on the interest, right?
Yes. It is as good as like in par with any other market. So actually speaking, man, there is one more thing. If the company requires as a thin capital, I'm sure like there are multiple sessions also taken on the thin capitalization. If the company actually requires say 1 million dirham, but just for the sake of MOA, we are keeping only 100,000. So if that is the case, if FTA can go to a level and prove that the company's requirement is 1 million, but just for the sake of the documentation, you are splitting it between 100,000 for the capital and 900,000 you are showing as a loan. And then still, if you want to take it as a interest, maybe if they can go to that level and they prove that this 1 million is a need of the day, but then you have only injected 100,000 as capital, they may go for disallowing this interest. But that is an extreme scenario.
Okay. Thank
Hope
you.
Yes, Mr. Yash.
Yeah, no, I was just trying to elaborate on your point. So the point that you mentioned on the deemed dividend was generally from the company to the director side, but here generally it's the other way around, director to the company or shareholder slash director to the company, and whenever they have fund, they can take it back. But generally it's other way around.
So here we have the credit balances in general.
Yes, yes. So company is in a payable position, so a deduction, if at all anything.
Okay, I think more or less we have addressed all the questions and definitely. So last 3 days have been great help for most of the members who have attended. I'm sure there were a lot of positive messages and appreciation that we have seen in the charts here as well as in the groups, in WhatsApp groups of the chapter. Thank you very much, Satya Bharat, for taking out time to sharing your knowledge on IFRS 9 and others, as well as corporate tax related matters. And thank you, Ravikant, for your wisdom also for sharing the knowledge with all of us. So we are definitely looking forward for more sessions from you both, since there is a lot of appreciation for the sharings that you have done. And once again, thank you to our chairman, Jayaprakash ji, and to the entire committee. Ashna today, she has been there, as well as for others from the committee. Thank you all once again. And we will share the presentations as well as recordings and also the Excel files that they have been using. So they will be helpful for you to take it forward. Thank you all once again, and good night.
Thank you, Balram Garu. Thank
Thank
you,
you.
HRC.
Thank
Thank you,
you.
Mr. Krishna.
Thank
Thank
you.
you.
Thank you very much, Ravi, Bharat.
Thank you. Good night, everyone.
Good
Thank
night.
you everyone
Bye.
for patiently listening.